Good day, and welcome to the DoubleLine Asset Allocation Webcast, Low Duration Core Fixed Income and Flexible Income Conference Call. Today's conference is being recorded. At this time, I'd like to turn the conference over to Ron Riddell, President of DoubleLine. Go ahead.
Well, thank you, and good afternoon to the DoubleLine Funds Asset Allocation Webcast with Jeffrey Sherman. Today, Mr. Sherman will be discussing three of our DoubleLine mutual funds, the DoubleLine Low Duration Bond Fund, the DoubleLine Core Fixed Income Fund, and the DoubleLine Flexible Income Fund. Some webcast announcements. You can go to doublelinefunds.com and view our 2022 webcast schedule, but two upcoming webcasts. The Total Return Bond Fund webcast will be up on March 8th with Jeffrey Gundlach and portfolio manager Andrew Su. Then we have our Smart Beta webcast with both Jeffrey Sherman and Jeff Mayberry, where they'll be discussing our Smart Beta, the Schiller Enhanced CAPE products, as well as our Real Estate and Income Fund and the Multi-Asset Trend Fund. If you'd like to receive today's presentation slides, you can go to Request Webcast content on the player. We also have a new YouTube channel, and it is DoubleLine Funds YouTube channel. You go to youtube.com/DoubleLine Funds. Some additional thought leadership content on YouTube. We have the DoubleLine 2022 Roundtable Prime Series with industry titans Jeffrey Gundlach, Jim Bianco, Daniel DiMartino Booth, Ed Hyman, David Rosenberg, and it's moderated by Jeff Sherman, where they discuss macro markets and best ideas. Also on YouTube, we have our YouTube channel, the DoubleLine's Channel 11, with portfolio manager Ken Shinoda, as well as the Sherman Show podcast. All of those are available on YouTube. Not only the Sherman Show podcast is on YouTube, but it's also on doubleline.com, iTunes, SoundCloud, Google Podcasts, Spotify, and Stitcher, along with Monday Morning Minutes with portfolio managers Sam Lau and Jeff Mayberry. As I mentioned, we'll be discussing the three open-ended mutual funds. And here you can see the different expense ratios and minimums. All three of these funds come in three different share classes, with the most recent share class being our R6 share class. Quickly on the standardized performance, the first one up is the DoubleLine Low Duration Bond Fund. The inception date is 9/30/2011 through 1/31 of 2022. The since inception annualized numbers, 2.21%. versus the ICE BofA 1 to 3 year U.S. Treasury Index at 1.01%, an annualized outperformance of 1.2%. The DoubleLine Core Fixed Income Fund, the fund was launched June 1st of 2010 through 1/31 of 2022, annualized return of 4.54% versus the Bloomberg U.S. Ag at 3.19%, an annualized outperformance of 1.39%. And lastly, the DoubleLine Flexible Income Fund launched April 7th of 2014 through January of this year, 3.29% versus the ICE BofA 1 to 3 year Euro Dollar Index at 1.90%, an annualized outperformance of 1.49%. So without further delay, I'm going to turn the webcast over to Mr. Jeffrey Sherman.
All right, thanks, Ron, and thanks everyone for joining us today. Bearing with me on the technical difficulties as we're broadcasting here live from downtown Los Angeles. So it's good to be back in the office with some of our colleagues today. So I want to start off listening to some of the overview. As much as I hate to listen to myself speak, and even worse, watch myself on video, I think, when you look at those summaries, those issues we talked about a month ago are still in play today. So what I'd like to start with, as usual, is talk about what's going on within the overall global economy. So just starting with that, it's very important to think about the growth stories that are out there. And what we show on the screen here is what world GDP has looked like in the past and what the forecasts are for 2021. Yes, I know we're already in 2022, but we haven't got the finalization of those numbers. We've gotten some early looks there. What the forecast for global growth is in 2022, but also just comparing that to the pre-pandemic growth trends. And you can see here that if we continue on this trend here, that stripping out what we saw in 2020, which was obviously a significant aberration to the data set, is that the global economy seems to have recovered from that loss that we took in 2020. but it looks like that potentially we have the ability to grow a little bit above trend. And so that's a positive thing. That's even in the face of what will likely be a slower first quarter growth. We've just seen this in some of the consumption data that's come through already, as well as just knowing about the juice in GDP that came in the back of the fourth quarter in the U.S. off of some of that inventory restocking. But let's get into some more higher frequency data than GDP. GDP only comes out on a quarterly basis. So one way of looking at this is to look at what's called the economic data change. And these time series that are created, it's an amalgamation of many different economic data points, and it takes all of those data points and compares the level today where it was on average over the past year. And if you look here, you can see that the ones that are underperforming where the economic data was over the last year or so is China, and it's significantly underperforming. We know that some of the reasons there. Also, the U.S. The U.S. had the very much high octane economy, given the fiscal and monetary stimulus that you see. And I won't harp on the fiscal side, as we all know about it, but I do want to talk a little bit about the monetary side today. But notice here, too, that you still have the emerging markets and the Eurozone area delivering above average of where they have been in the last year or so. Albeit they are in this kind of downward trend here, they still are delivering above that. So what you've seen here, where initially at the onset of the pandemic, or not at the complete onset, but when the pandemic spilled over to the developed world, China was getting through its first wave. It was starting to deliver. Then the U.S. really came in again with all of the stimulus that transpired, allowed the U.S. to kind of take that lead for a while. And I think that we're in this new phase where there's this transition to other parts of the global economy. So obviously time will tell what that looks like, but there is a pretty robust kind of participation. This only shows data change and doesn't really talk about expectations. I'll hit that in a minute. But first, let's look at the manufacturing side of the equation. If you take into the account of what the global manufacturing PMI, this purchasing manufacturer index is, anything above a 50 level is considered expansionary. Sub 50 is considered contractionary. Doesn't necessarily lead to a recession, but it tends to be, a necessary but not a sufficient indicator when it comes to predicting that recession. But you can see here in the last recession, not shockingly, when you slow down or you shut down economies around the world, it's going to put a crimp in the manufacturing activity. But we are at very strong levels here. This is pretty broad participation. I stripped out the slide today that shows the granularity by country, but in general, it's a pretty robust trend across the entire globe right now. Another way of thinking about the economic data is instead of just comparing the metrics today to where they were on average of the last year, also Citigroup puts out indices that compare the surprise. So relative to expectations of the economic data set, where do we see that today? And the reference point here, that dotted line is 0. So above 0 means you're delivering above expectations. The negative line is below. Notice that the U.S., for all of the negativity out there, is roughly in line with the 0 kind of area. And even with all that strong growth we saw over the last year or so, notice that the U.S. has vacillated much closer to that 0 line. So another way of saying that is that the market has been expecting a lot of that data, and even some of the slowdown that potentially may materialize is baked into the expectation. But if you notice here, the black line is China. Even though it has been underperforming where it's been last year, it's still delivering above expectations. And same thing for the Eurozone. Although the Eurozone is still doing better than it was last year, it is also delivering above expectations. So this is a positive attribute, assuming that we can get through Omicron and we can end up getting to a level where potentially no more variants. This augurs well for this kind of explosion in growth kind of story at this point. Now, the headwind to that, even though and explosions may be a little strong when talking about the growth rate right now, but the headwind to that is obviously going to be tighter monetary policy across the globe. But before we do that, let's come back home here in the U.S. and look at where we are in the cycle. And so this is the post-World War II era of real GDP growth. It's on a logarithmic scale, so you can compare various periods there. And if you look at the regression line there, you can notice here that at the financial crisis, in the global financial crisis back in 2008, we broke through that trend line. And if you notice, the slope of that line is significantly lower or flatter than it was prior to the global financial crisis. And all that means is that we have a lower growth rate over this period. And there's a forecast in there. This uses the IMF forecast. That's the shaded area. But if you notice that, pretty eerily similar to, we're right back on line with not that long-term trend, the dotted line, but the trend line if you drew it from the post-GFC area. And so what this just says is that we're still below that long-term trend line. It does look like, with this acceleration last year, that we're above that kind of GFC type of trend or post-GFC trend, but we still have a long way to go to make up that long-term gap there. And so in general, the economy did quite well last year, as we know, and is forecasted to do relatively well in 2022. And again, using a similar framework to what we saw with the world GDP forecast, if you look at the U.S. GDP forecast here, you can see that, on average, we grew somewhere between 2% and about 3%. That was really the steady state. If you compound it out, it was about 2.5% post GFC. And you can see that we had the dip down in 2020. We more than made up for that in 2021. And the forecast here is for something in the high threes. Notice that forecast has come down. That red line has come down from roughly about 420 was the estimate before. Now it's about 380. And a lot of that is pricing in this weakness that people expect in the first quarter due to the Omicron variant, due to some of the workers not being able to show up, due to quarantines and the like, and just in general, some of that pull forward we saw in the fourth quarter. So if you take the real GDP and slap on an inflation forecast, and what you get here is that nominal GDP is likely to be around 6 to 6.5% if you use kind of consensus estimates. There is a potential for a little upside here, I think, in nominal GDP, because there's the potential for inflation delivering a little bit above expectations, I think, relative to the market. I'll get into that deeper in this webcast. I have many slides on what's driving inflation right now. But I think what's also very interesting to highlight is that if you look at the nominal GDP growth for 2021, you see at 10%, that is something that is almost off the charts here. It's a level we haven't seen really since back in 1984, where you had an 11% nominal GDP growth. And remember, that was an era that was still printing very significant inflation. So kind of similar components to what we see here on what's driving nominal GDP. But for all of this kind of stagnation in nominal GDP for, in the post-GFC era, we did find a way, granted it was with significant fiscal stimulus and a very accommodative central bank, to be able to generate this pretty significant nominal GDP growth. And so, again, I talked about GDP being kind of a slow-moving indicator that we only get on a quarterly basis. So one thing during the financial crisis that we were using to get a good handle and sense of what was going on with U.S. GDP in real time was this measure from the New York Fed called their weekly economic indicator. And you can see here that overlaying these two series, it gets you roughly in the ballpark. Directionally, the trends are pretty good. The direction, when the blue line is trending down, it pulls the red line down and vice versa. And you can see here that, even the high frequency activity says that, we're roughly on pace to deliver this, kind of 5 to 6% type of GDP in there. So in general, the economic data, although it has been a bit slower as of late, still corroborates that we are in this expansionary part of the cycle. Looking at leading indicators, one of our kind of favorites, one of our favorite measures to think about a recession, says we're a long way away from it. This is, again, one of these, it's necessary but not a sufficient condition. Once the LEI dips below zero, you go on watch, thinking about the recession, and it typically plummets either right leading into, or you can know how quick the onset of the last recession was due to the pandemic. Very quick onset and very quick recovery. And so, again, the leading indicators are saying that we are still in this kind of expansionary part of the cycle. And why are we? We talked about the fiscal side, but also if you look at what's happened is that the Federal Reserve massively increased their balance sheet. And this is no surprise to anyone. They did it much quicker. That's the red line that we're showing. This is the pandemic increase since the onset of that recession of what the Fed's balance sheet looked like and the change in the levels of it. But we also compare that to the global financial crisis. And so if you notice during the GFC, it took them about 40 weeks to really start to expand the balance sheet. This time it took 4. right? So they say everything's faster these days. Maybe it's our ADD or ADHD kind of society we live in, but everything's faster, including the Fed's mechanism, but transmission mechanism. But not only was it faster, it was also done in significantly more size. They went big, they went early, and they went in size. And notice there that unlike during the GFC, where it was on again, off again, they're trying to do all these rotation programs, Operation Twist, and moving things around. This time they stayed extremely dedicated to just growing the balance sheet. So this is one of the challenges that the Fed faced, is that they were extremely accommodative for an extremely long period of time. And again, this accommodation was in unprecedented size. Even if you compare this as a percentage of GDP, it was significantly larger than what you saw during the last recession or the previous recession. And so part of this was that it was funded by a massive deficit. This deficit, this chart here depicts the U.S. deficit as a percentage of GDP. So you can see here that not only did the Fed go big and go early, but also during the recession, notice how large and how much scale we did from our budget deficit. We went from running something like roughly 5% of GDP all the way down to about 18% of GDP at its peak, when GDP troughed, as well as, you had peak budget deficit as well. So we're clawing our way back here by not shrinking the deficit. Maybe it's the budget deficit that goes down a little bit as there's a little more hawkish behavior within the politicians. I don't know if it's hawkish or just the inability to agree with one another, but also growing the denominator here too is helpful. So by GDP going up, that helps this ratio as well. But notice too where we start now. We are completely off the charts here, in terms of the magnitude of what's happened here in the budget deficit. Notice back, 20, 30 years ago, when we went into recession, we had roughly a small budget deficit as a percentage of GDP. We expanded a few percent, but something changed in the GFC, right? We went very large with our budget deficits, and typically until you get into recession, that tends to gravitate back or closer to zero. But the last administration, this last cycle that we were in, we increased the budget deficit during good times as well. So again, this was kind of unprecedented to see the directionality of that. So we'll see what happens at this stage of the cycle, and we'll see that I noticed that there's a lot more critics of MMT now, the modern monetary theory, and that deficits don't matter. A lot more critics when you start to get a 7-handle inflation print versus when we were hovering around 2% or so. So we may be reaping some of the kind of seeds of what we sown there on that MMT experiment. And if you think about the MMT experiment, part of it is increasing money supply. And the top chart that's in red is looking at the supply of money. And this is a year-over-year growth rate. So what this is saying is that the supply of money right now is growing at about 13% per annum. Okay, we peaked last year truly off the charts at 27%. That is the monetary base increased by that much. We wonder why potentially there's a higher level of inflation today. Well, maybe it was just this excess amount of liquidity we created by creating more of the base of currency out there. And if you look at it during previous recessions, and we really should shade this, and I'll make that for the next time, we'll shade during the recessions, is that typically you see money supply increase during the recession, but the level we're at right now is what was commensurate with what was historical recessionary levels. So there was this big increase here. And, so the punditry is saying, well, we don't really have that much inflation. And a lot of that comes down to, you have to also look at money velocity. And so the velocity is the blue line. This is effectively how much money turns over. And if you notice here, we haven't had that kind of a constant level of velocity. Velocity fell off as the money supply increased. And this is why there's so many excess reserves kind of out there in the system today. Can you imagine what the inflation numbers would look like if we kept that velocity somewhat constant from where it was pre-pandemic? So again, this doesn't, you can't look at money supply without velocity. They need to be looked at in tandem, right? That's the quantity of money theory that one should be looking at. But it does show you that even without this velocity, we have been able to attain some level of inflation. And, I talked about the accommodation of the Fed. And if you don't believe me that the Fed has been extremely accommodative, look at what happens if you take the effective Fed funds rate. So think of this as the target rate that the Fed is targeting for monetary policy for overnight lending, and you subtract off the contemporaneous inflation print. So you just take whatever the latest CPI print is here. And notice that this is the most accommodative Federal Reserve in the entire history of the time series here. So it's very important to think about this in the context of, everybody's wondering why the Fed did some about face. Well, they were probably too accommodative for too long, right? We were very critical of the Fed last year, saying, why are they buying $120 billion worth of bonds every single month? And you have this extremely low Fed funds rate. You're supporting the market through quantitative easing. And together, these things really just made for extremely accommodative financial conditions. So, but what I want to point out, too, is this is not just the Fed's doing. This is not just some U.S. phenomenon. That inflation is everywhere, and it's everywhere at very elevated levels. So what we've done here within this chart is what we look at the developed market countries, and we put them together to create the developed market CPI. You look at all the emerging market countries, and those are the yellow line. That is the overall EM. And then we take the globe, put it all together. That's the black line. What's pretty interesting about this chart is that it's very rare that you get inflation in the developed world and the rest of the globe that is higher than the emerging market space. It's very rare to see that, if you see from this chart here. So this is not some lunatics running the asylum that you get sometimes in some of these policies. You can think of what's going on in like Turkey, where they have high inflation. They're cutting rates because that's what the PM wants to do there. But what you actually have here is that it's this consumption basket that is being driven upward around the globe. And this is supply constraints that you hear about. I'm sure everyone's tired of hearing about supply chains. I'll talk about it a little bit. But also, this is the demand function. As people have been sitting at home consuming, or just in general getting back to the economic activity, and you have the constraints on the supply side, it just causes the equilibrium of prices to go higher. So inflation will continue to be a topic. A lot of folks are dismissive of inflation, like, oh, it's going to gravitate back. Well, let's take a look at what the data say. So if I look at the data and I look at various measures of core inflation, what I see on the screen here today is that, okay, the highest rate of core inflation. Now, remember, core inflation means that you take the basket of inflation and you strip out the volatile commodity prices. So you take out the energy and you take out the food consumption, and that leaves you with what's called core inflation. And if you look at all these measures, CPI has the highest core inflation, which hasn't always been the case, right? A lot of it is it's just the makeshift of the basket. PCE, which is the Fed's target, that's the orange line, typically is one of the lowest measures, and it happens to be very much up there with CPI today. Now, the other measures that we're looking at here are things that are slower moving, or they remove outliers in there. So if you want to try to say, well, inflation's not that big a deal, you just take the trim mean 1-year PCE rate. It takes PCE and it takes the top 8% of the range, I think, and it gets either 8 or 9%, and then subtracts off the bottom 8 or 9%. So it gets rid of those kind of outliers and leaves you kind of with the middle-ish rate too. You can look at median, which you see on here as well. But regardless how one chooses to weight the basket or how to kind of manipulate those calculations, you can see that there is this directionality of inflation where it's printing across the board, irrespective of the measure one uses. And so another way to think about it is to break it down into its basic pieces. So when I think about the basic pieces of consumption, there's two ways to consume. You either consume goods, right? And that's the red line here, or you consume services, like doing things, stuff, right? So one's consuming stuff, one is consuming the experience, right? That we hear about, what the younger generation is trying to do. But notice here that the red line had been experiencing a deflationary environment. That is, the inflation rate of goods was negative, right? And why was it negative? Well, there's been a lot of postulation about it. Is it the Amazon effect? Is it, it's hedonic adjustments that go into, that is the quality of the good. You get more bells and whistles or more features for the same price. But notice services has always been this steady higher printing number. And by the way, services is a larger part of the CPI basket than goods is. So what you've seen here now is that services were diminishing over the course of, let's say, summer of 2020. We had lockdowns. We've had kind of some of these rolling lockdowns depending on where you live in this country that forced services down a little bit. But we saw massive increase in consumption. Some of that's price driven. Remember, CPI, it's price driven, so it has that kind of inflationary component in there. But also people being at home more. They were focused on the do-it-yourself projects, all the renovations and the like. So there was a higher demand for consumption in goods. And so if you kind of rewind the clock, let's say a year ago, when we were talking about these charts, we were saying, well, it's probably going to be a handoff that the core goods are going to roll over as people appreciate going back out, living again with vaccinations around the corner a year ago. That seemed like that was kind of the path of least resistance. However, the big aberration you've seen here is that we've continued to see goods price pressure while you've seen this rebound back to roughly the higher levels of services that we've seen really pre-GFC. So if I look at the services, I do expect it to go up, and I'll get to that in a few slides. But the thing that's really problematic right now is the goods consumption. So no wonder the Fed is really coming under pressure for inflation. No wonder they're concerned about it, because they see people consuming these goods. Now, why are they consuming so much? Potentially, it was due to some of the stimulus. We've seen some increase in wages and the like. But in general, what you find is that the big aberration here is that goods is massively above the levels, and levels you haven't seen on the good side of the equation for roughly 4 decades. So we know that there's supply chain issues. I won't harp on it. But when you look at the bottlenecks out there, and the Federal Reserve in New York puts out they put out this global supply chain pressure. Higher the number, the more pressure there is. And you can see here that for all the talk about supply chains relieving themselves and curing themselves, sure looks to be under a lot of duress to me. So this is as of year end. So potentially we're increasing and getting this a little bit better. But right now, the data still say that ultimately there is continued supply chain pressure. So that's likely to keep the goods side elevated. Well, one thing that also is a little problematic is that the services component includes housing. Housing is a service under the construct of inflation. And so when you look at what's happened in the rent markets, you can see here, this is the monthly change in rent. So this is not a year-over-year number. Notice all of those consecutive increases in the price of rent during 2021. Yes, the last month of the year did have a negative print. It seems to be offset so far, in the January data. But notice if you compound all those out, that makes for a pretty strong rental market, significantly into the low double digits. So I'm pointing this out to make a point in a couple slides here. But if you also look at the house price inflation, and again, this is just housing prices, this is using the Case-Shiller indices to look at that, what you see is that they continue to have very, very strong numbers, right? High teens type of prints. We did get up there to about a 20% year-over-year growth rate at one point. So index that in your mind. Okay, you have the housing market, let's just call it, take the bottom number on there, up 16.8%. Go back to this rent chart, and let's just say, hey, it's roughly 10%. So if you're a renter or if you're a house owner, either way, your cost of housing has went up approximately 10%. Let's say you're in the market, you're trying to move around. Well, notice here what the CPI housing component is. And so if you take a look at this chart here, the dark blue line is what the CPI housing metric is. Okay, so the CPI housing metric is sub 4%. So in a world where house prices have been growing or have been accelerating in price by mid-teens to higher over the course of the last 18 months, I think the 24-month year-over-year change in the Case-Shiller indices is roughly 30%, 30. Okay, and then if you take the rent data, as I talked about, and you kind of average those two out, you get this light blue line. So notice that the alternative rent measures, it's rent and it's also the house prices going into that. And you take a look at that and you compare that to where CPI for housing is, they're nowhere near each other. And so there is going to be continued pressure on the CPI housing component, which is one of the largest components of core CPI. So it's important to understand this. It's not going to go to 10%. There's smoothing functions. There's surveys that go into all this. But even if there is some relief on the good side, the services component should offset some of that, or at least it still have a positive contribution. Maybe the negative price action from goods makes it kind of a net negative. But what you're going to have is this handoff here. So we're afraid that inflation is going to stay elevated during 2022, and it's going to really take the relief of these supply chains to get things back in line to the Fed's target. So from a standpoint of inflation, that's what we're seeing. If you look at how the manufacturing and service activity are, both of them are extremely strong. These are near high ends of the ranges. These ranges go back over the last 25 years. And you can see here that although they have come down off of extremely high levels, they are very, very well elevated. So this indicates that future economic activity, at least in the short term, remains relatively robust. So that's the negative about inflation. I try to keep it fair and balanced here as we go through macro slides. And so let's talk about potentially why inflation could roll over a little bit. And so one way to think about inflation is think about the input cost. So that's what we call the PPI, or the purchasing. It's the producer price index. So this is for production. So you can think of this as more input cost into the equation. And notice here the blue line, that's the year-over-year growth rate. It's on the left-hand axis. It's been about 10%. But if you look at the month-over-month, notice how strong those were. Those are the green bars that we show, and that axis is on the right-hand side. But notice that all of a sudden, we started to get kind of a lower print. We were running roughly at like 50 basis points or 0.5% of price increases on inputs for the last year or so. And potentially this is moderating since we only had this 20 basis point month-over-month increase here. So it's let the line hook over a little bit. We will have some base effects here too, where that very, very strong print you see in early 2021, that's going to roll off in the next print as well. So hopefully by having input prices coming down a little bit, or at least moderating more and not accelerating, this could augur well for inflation coming back down. And another way to think about it is that if you juxtapose the concept of prices paid, so this is the prices paid, and you look at that relative to headline CPI, it's not a perfect relationship here. You can see the relationship's been a lot stronger over the last 25 years. But notice that you see this divergence between the blue line and the red line. The blue line is plotted with a 4-month lead. So that says that potentially you can see where that red line is at that 7% where we got headline CPI. And by the way, we get CPI on Thursday this week where the expectation is about 7.3%. You expect this to kind of hook over if this historical relationship holds. Now, it doesn't say that inflation is going to go back down to 4% or anything, but it should pull it in that direction. And so those are the types of things we're thinking about. Well, how does the bond market price this? Well, one way to think about it is you can go into something called the zero coupon inflation swap market. And this is the price of inflation. Effectively, it's the price of, what's the break even, or what is the price of the difference between like a TIPS, an inflation index bond, and what you get from nominal bonds as well. So it's looking at that difference there and saying, where are you made whole? And if you notice that what I want to show here in this line is two things. One is that over time, the market is pricing lower inflation, right? The cost of inflation for 1 year is roughly 3.6% today. It was 3.8% a month ago, right? So the market's starting to say, okay, I think this is going to somewhat normalize, or at least get down to more tolerable levels. But over the long run, when you look out 10 years, the price of this gets down to about 2.6%. So the market is pricing that this inflation is somewhat transitory. However, it's transitory in the good side of the equation and some of those service components, but there's other things that'll be more sticky and a little bit persistent. Hence, we're not going back down to this world of a sub 2% inflation print. And so what you think about with this market is it's saying, okay, well, like, we believe you. We think that the Fed's going to get there. Potentially, it started the slowing of growth with the hiking of rates, but also it's just a function of the market believes that inflation is not going to get wildly out of control because it hasn't for the last 40 years. So for those of you worried about it, This is an easy way to get in that market and do a little hedge for your inflation here. You don't have to worry about duration of assets and interest rate volatility. You're simply trading those differentials. That said, there are some negatives for the TIPS market out there. The largest buyer has started to step away. The largest buyer happens to be the Fed. They own roughly 22% of the TIPS market today, and their goal is to get that down to single digits. So you are losing one of the largest natural buyers there, and I'll show the impacts there. But one thing that's been undeniable, no matter how one splices the data, is you can argue about whether or not we should have done the fiscal policies, whether or not the Fed should have stayed as accommodative as it was for as long as it was. But what's important here is that we have gotten the employment picture back in check, right? So you look here, the U6 unemployment, this is the headline, I'm sorry, the U3 unemployment rate, that's the headline employment that comes out in the jobs report, was 4%. Right, I think it was 3.9 on the previous print. It ticked up to 4 because of the increase in the folks looking for work and the participation rate there. But we got things back to roughly pre-pandemic levels. So notice in the GFC, look at that area from 2000, late 07 to the middle of 09. Right, during that recession, all those jobs were lost. Look how long it took to get back to those kind of pre-recessionary levels. It took almost 10 years to get there. We were able to do this in 18 months this time. So 4%, feels like a maximum employment. Yes, it can get a little tighter. I think the Fed's forecasting 3.5 ultimately. It's going to be in that long-term full employment rate. So if we get to see participation come back, it should continue to bode well. This is organic, right? This is people working. They're getting paid in wages. They're not getting government stimulus to do this. So this is probably the last time I'll use this chart. This is all of the extraordinary benefits or extraordinary measures that we're taking to provide people with more benefits than the traditional channels of unemployment insurance. And if you notice here, the left-hand side of the chart was going into the pandemic, and now you can look at the right-hand side of the chart, and those bars are roughly the same. So the amount of people that are applying for unemployment is roughly on par to where we were prior to the pandemic. So these programs are all behind us. That doesn't mean they won't be dusted off again. Doesn't mean they won't be resurrected either. However, for the time being, we're back to kind of the traditional channels there. And it shows you that ultimately, this looks like a more normalized transmission mechanism. So there's not these extraordinary benefits that are coming to people and transfer payments from the government, keeping the economy afloat. That's the bearish argument, is that the economy can't stand on its own. I do think with some of the more robust stuff you see from the employment sectors and the job creation, that potentially there's the ability to offset that. So the kind of missing variable in the equation is we are still missing some workers. And so if you look at how many people were employed in the pre-pandemic level to where we are today, we're still about roughly 3 million fewer jobs than we had at the pre-pandemic peak. So we are clawing our way back. If you notice here, that 3 million gap on 150 million or so, that's roughly 2% that's left to climb. But if you notice, when we got back to that kind of pre-pandemic and outright number of jobs during the last recession, it took about 5.5 years. So we are on a more accelerated rate. Yes, we had a steeper drop off. That was a lot of that was just forced. People could not work. But what you find here is that there seems to be this nice growth rate. Now, granted, this number jumped massively with the latest jobs data, with the revisions and everything that took place at the BLS. They found about an extra, I think it was 1.2 million workers or so. So this number gapped up significantly. So we'll have to see as we get a couple more jobs reports over the February the February report and the March report, which are released the first week of the next month. We'll have to look to see if this trend continues or if we do get some slowdown there. What this means is if we have GDP to where it was with fewer workers, this does argue for a higher productivity. Okay, so that's the one missing thing from the overall equation. So the last thing I'll talk about on the jobs market is the compensation side of the equation, so wage growth. Notice here I've called it wage growth versus calling it wage inflation. I'm thinking as a worker, not thinking as a business owner here. But if you see here, there's two lines on here. There's a red line. That red line goes back further. This is the average hourly earnings This comes out in the during the jobs report. We call it the jobs report. It's a non-farm payrolls report. So if you want to brush up on that, go listen to DL Monday Morning Minutes with my colleagues Sam Lau and Jeff Mayberry. They get a great they went through a great discussion about the differences between all of these different jobs report in the latest episode. So if you're not following that, that's another thing to take a look at. They do a lot of work out there in kind of distilling these macro ideas down each week. But if you look here, you can see that the average hourly earnings is roughly 7%. It's 6.9% for non-supervisory workers. So that lower kind of income strata is doing quite well. Another way to think about it, because the average hourly earnings is just that, it doesn't take into account the makeshift of those jobs. So if a bunch of jobs get lost due to get lost due to lower end wages going away, you can see that wages spiked according to this metric during the recession. Well, it's because that lower end were the ones that were forced to stay home, where a lot of white collar workers were still being employed. But another way of looking at that, and the one we like the most, is something called the Atlanta Fed Wage Tracker. And the wage tracker is the blue line here. And what it does is it actually adjusts for industry and compositional differences. The way they do that is they essentially find the same person. They compare you today to where you were a year ago and what your change in compensation looks like. So it's more of a robust measure. It gives you a better sense of it. It doesn't have this compositional difference. But notice here, the wage growth you see here at 4.5% is it's the post GFC high. In fact, during, since the tech wreck, right, wages had not grown this much really since we were back in that 2000 era. So is this a new economy? Is it something different? Time will tell here, but I've been arguing that I think labor has the upper hand versus capital at this point in the cycle, as you're seeing the power in this. You see this with, some of the employees not wanting to go back to 5 days a week on a white collar job. They want to have some hybrid. They never want to go back to they realizing that there is negotiating power. In fact, we had some folks in today from the street that they respected firm and talking about their macroeconomic views. And one thing they were talking about here was the turnover at their shop versus some of the other shops, and so how they were able to recruit talent because of this. So I do think that this is another year where labor has the upper hand. We'll see if that is a trend that takes place for a while, or if it's something that's going to be a flash in the pan. But it's undeniable that wages are at kind of this post-GFC type of peak by either measure here, and this kind of argues well for the upper hand. Now, I know inflation's higher, but if inflation subsides down to, let's say, where the bond market's pricing it, 1 year inflation was about 3.6%. If you're going at 4.5%, you're outstripping that. So yes, if you use the most recent CPI and likely the next print, it's going to look like you're not making any progress, and it won't be. But if indeed it stays at these levels, the wage growth and inflation does what the bond market thinks, it'll lead us in the right direction. So that's my macro summary. Try to keep that under the 45-minute mark. It's kind of tough to do, even though it's only like 30 charts. So let's talk about the bond market real quick. All that stuff is stuff that goes into our discussions. It leads our macroeconomic thinking and allows us to be allocators over, kind of this medium-term horizon, which I define to be like 1 to 2 years. So what's happened in the bond market? Well, it's been an ugly start to the year. The ugly start to the year, it's been pretty painful across almost all fixed income segments. What you see here on the left-hand side, the light blue are the things that are in the Barclays U.S. aggregate. I keep calling it the Barclays. It's now the Bloomberg U.S. aggregate. That's the light blue area. You can see there that irrespective of credit quality, you have somewhere between a minus 1.2 and a 1.8% loss. If you go in the corporate bond market, it's worse. It has more interest rate sensitivity. Plus, we saw some spread widening. I'll talk about that in a few slides forward. But you can see here these light blue areas that the investment grade market got hit. It was the worst performer, did about 2 times worse than the traditional sectors of the ag. Even high yield bonds, who had been somewhat immune to these interest rate shifts, now we've seen a movement in the belly of the curve and kind of the front to belly. It's had some repricing as well. Interestingly low, the CCCs, the lowest quality cohort, was in line with some of the best performance. It was those higher quality assets that got hit. I like to call it the high quality junk, the double B rated assets there that did the worst. So some of that's a repricing where people were fearful and hiding out in those areas. That it was the more susceptible. Emerging markets were not immune either, down over 2%, whether you're in corporates or you're in sovereigns. And what did well? The things that float, right? So the things that aren't exposed to that direct interest rate risk. These are leveraged loans. We call them bank loans. Is another way of calling them. And you can also see here that the CLO market, which is another package, a packaged version of the loans, did quite well as being positive. But even ABS, CMBS, RMBS, the things that ultimately had held up well last year are starting to suffer as well. And this is because it's not just the back end of the curve that's moving, it's the entire interest rate curve that has indeed been moving upward. And that's the repricing of Fed policy. So if you want to look at what this looks like globally, as I mentioned, we are not immune to the interest rate rise. So if you are, we're not alone, I should say, in the interest rate rise. We're up 32 basis points year to date. This is through yesterday. You look at Germany, up 32 basis points. UK up 40, right? I can go on and on here. The only two areas that have rallied are China, they're in 7 bips, and Turkey, which again, a lot of that is the policy of cutting rates and trying to, try to stave off inflation through the anti-Volcker approach. Even though those yields are extremely high, they are in about 130 basis points here today. But you see the bulk of this. What you find is that this has been a rate move across the globe. So this is not just a U.S. phenomenon. And again, I think I know I said it because I listened to it on the little teaser at the beginning, but this is exactly what I was talking about a month ago, that something changed around December 17th. December 17th of 2021 was the last Fed meeting prior to this January one. That really seems to be a localized low in yields, and the rhetoric has changed massively with Federal Reserve. It's changed even with the ECB, where people are saying, yeah, they may hike next year. June of 2023 seems like a good time to do liftoff. Now you have Lagarde out there trying to defend, well, maybe we may need rate hikes this year. So unfortunately, we went from a world awash with liquidity, awash with lots of support, both fiscally as well as from the central banks, and that seems to be reversing course. And the bond market listens. When you look at the real yields, they started to gravitate upwards. So this is not a story in really pricing inflation. This is repricing back in the growth story as well. So why are real yields important? Real yields are important because they affect multiples of risk assets. So if you overlay like the multiple of something like the S&P 500, let's say on the 10-year tip, which we have here in blue, you would see that they are inversely correlated to one another. So not shockingly, some of the high-flying assets, things that traded at very high multiples, have been the most susceptible to downside during the first 5 weeks of the year, really for the last 7 weeks, going back to December 17th. And so this is the chart to watch. I'm not even looking at nominal yields here. I'm all about the real yield story. By the way, I also said earlier, the biggest buyer of this market is stepping away. That is very important from a technical standpoint because all of the supply of these securities needs to be gobbled up by a new buyer. That means if all else being equal, price is lower, yields higher, as we've all learned from reading the Wall Street Journal, right? But again, this is not just a U.S. phenomenon. If I take the 10-year real yields and I plot them around the globe, what you see is that there's been this increase everywhere, even Japan, right? Even Japan, that the joke always is JGB should trade at 0. The range was up to 20. That's as high as they let it go, and it's broke through the range today, as I saw from one of our strategists putting out that they hit, I think, roughly 22 basis points today. Those are nominals, not the tips here. But I'm sorry, not the inflation linkers. They're not called tips in every market. But notice here, it's been a similar move. This is a repricing of real yields, right? So this is something that needs to work its way through the market. It has been doing so. This argues for, there being some contraction, risk assets as well. That's why we've seen some shakiness across risk assets, whether they're credit related, whether they're equity related, because real yields are what affect multiples, okay? So the path of the Federal Reserve, What are they doing? So if you go back to December of 17 and you look at where the market was pricing in rate hikes over this kind of cycle. And so what we're doing here is taking out to February of 23. So these are where the Fed funds futures trade. I think they'll ultimately turn into like SOFR type of futures out there as well. But if you take a look at this, what this is these are all the various meeting dates and what the expected number of hikes from today's level is. Notice that there's been a big repricing of the bond market, or of Fed expectations. By the end of the year, it was 5.25 hikes priced in as of 2 days ago, or as of yesterday. Today, that number was 5.75. It tends to be highly correlated to the 2-year Treasury. But notice here what's happened. It's that now not only is the Fed going to be hiking this year, and that's been in the marketplace for the last 6 months or so, but they're going to likely be aggressive, or at least the bond market is pricing it to be aggressive. So what that means is there's two ways to look at it. One is the Fed is not going to be your friend in the short term. In fact, if you look at that chart, it says they're hiking in March, they're hiking in May, they're hiking in June. 3 back-to-back meetings that they're hiking. Maybe they pause. The market's kind of like, it's 50-50 whether they hike in July. They're back hiking again by September and likely giving you another one by December. So this is how you get that 5+ hikes priced into the market. So they're a little front-end loaded. So it's the first 3 or the next 3 meetings, then likely on to the quarterly kind of cycle. But if you take a look at, the 2-year and you watch the activity there, you could see where we get 6 to, roughly 7 hikes priced into the year. I think that'll be problematic for the Fed to be able to achieve if they're going to do it while trying to unwind the balance sheet. That said, the Fed is hiking. Get used to it. That's the program. We'll see how it translates into markets. But one thing we do know is monetary policy operates with a lag. So even though we're getting these rate hikes in, they're priced into the market. They'll start to trickle through the system, but it takes 3, 6, 8 months for you to really see the impact to the real economy. So by the time these hikes all kick in, we may be at the path where the Fed needs to apply the brakes. So the bond market's not omniscient. It doesn't know anything more than any other market. It tends to overly estimate Fed hikes, but I think at this juncture, it's right to be pricing 5 hikes in. And I do agree with this shape of the curve. I think they go faster at the beginning. They're not going to do 50 to hike on the first one. They'd rather do 25, do it multiple times, show that they're dedicated to this mission. And I think that's the way they're going to operate, knowing it has a lag. And don't forget that there's the midterm elections in November that, the administration needs a W there. They need to be able to say something. They're combating inflation. And I think that's in Jay we trust that they're trying to do here. So let's take a picture of the U.S. interest rate. So this is 2s, 5s, 10s, 30s from upper left going upper left, upper right, bottom left, bottom right. And you can see here that everything is broken out. If you take a look, now everything is back to where we started the pandemic. Even 10s have finally gotten there. Today we sit a little bit at the higher end of the range with these levels, but kind of the next stop in some of this stuff is pretty meaningfully higher. And so, the next stop on the 2-year is, you can see on that chart that's about 150, 160. We're getting closer and closer. That would give us one more hike priced in for the year. By the way, if that happens in the next 4 to 6 weeks, you can look at the 10-year, look at where that level was at inflection point, totally blew through that. We're in a new trading range. Looks like that new range will probably be something like 180 to 2.25. So we're not even at the center of gravity of that yet. Let's see if the psychological 2, what happens when we get there. And the long bond broke 2.25 this morning, or broke yesterday. It's still staying above that. But, really kind of you don't get resistance about 2.5. And if you do, then that's easily the next stop is 3. So as the market starts to price in the seriousness of the Fed, and you're starting to look at some of the underlying data and the economic activity, it sure looks like we finally found the catalyst for bond yields to go higher. We like to look at the copper gold ratio. That's the blue line relative to treasuries. It's been giving us a signal that 10 years should trade closer to 2.5%. And it's starting to listen finally to this ratio. So we'll see either that or the copper gold ratio needs to decline in a meaningful manner. But this is one of the biggest divergences you've seen in the history of these 2 time series here. And if we take it back even further, you see the same thing. So corporate bonds, as I mentioned, had some spread widening. The top panel is the investor grade market. The dotted line is the broad market. Then you get it by the various credit strata. You can see here that spreads have been moving up as well. So that's why investment grade was one of the worst performers last month, or at least on a year-to-date basis too, is because not only have you seen yields go up, but you've also seen spread widening. And as I mentioned too, high yield, it did have also, because it's keyed off roughly the 5-year part of the curve. And if I go back to my 5-year chart in the upper right-hand side, you can see here that it really started to take off around that December 17th date as well. So you couple that with some spread widening here in the lower quality tiers, and you can see why these things all have negative signs on them. So the high yield market, there is some kind of stories out there. There's things that you want to avoid, the things you want to own in there. So we think it's a good discriminating market. And as you'd expect me to say, I believe in active management to try to find those ideas there. Default rates are historically low. They still look very strong for loans out there. There was that big divergence. I think it was the largest divergence on record between high yield and loans in the first month of the year, where there's about a 3.5% difference between the loan market and the high yield market. That can't go on forever, but you can see here that we have a very low default environment. We still like the bank loan market. We think you should upgrade in credit quality a little bit within this area. We think that should be thematically what investors do. The CLOs, they've hung in there very well. You can see post-pandemic here, we're trading to kind of pre-pandemic price levels as well. CMBS, same thing. Some people would see this chart and say, well, CMBS has been weak. I remind people here, these are conduit deals. These are long duration assets, or they have duration comparable to, let's say, that investment grade part of the corporate bond market. So the price declines you see here are mainly due to the duration aspect and not really spread widening, although we are seeing some leakage in spreads over the last few weeks. There's been a lot of supply talk out there. We think that kind of normalizes soon, but CMBS is thought of as a macro trade at this point in time, just because of its sensitivity to the reopening trade. EM got back to long-term average in terms of its spread, something we've been looking for as maybe a catalyst for adding to the EM side, but instead we did just the opposite. With the geopolitical risk out there, just thinking about how much we think that there's going to be volatility in rates this year, or at least for the first quarter or the first 2 quarters of the year, as the market really tries to understand the Fed's plan. We know what's going to happen with hikes. We know that they're coming. We want to get more color on what it looks like from the balance sheet reduction. And so we just think that leads to choppiness in rates market. Just doesn't really make us excited about the emerging market story until there's really that kind of reopening trade once again there. So this is something that we've cut our risk in over the last month or so. And lastly, the dollar. Another thing for kind of being somewhat negative, or at least less constructive on EM, is that the dollar seems to exhibit still pretty strong strength here. And you can see, kind of that breakdown level, that double bottom that we've seen as of late, sits really, kind of in that Dixie level where it's like 89-ish, or, it breaks down to 90 handle. And so just given this and knowing that this other central banks around the world are thinking about a similar policy to the US Fed, that it doesn't really augur well for a lower dollar. So at this stage, we're kind of neutral. We cut some of our international exposure within our core strategy, as well as our flexible strategy, as we've just kind of given up on this concept for now. However, that being said, once we start to see some meaningful depreciation and a catalyst for that to maintain, we'd likely want to rebuild those positions and do them in much larger size as well. So let me just go through, let me go through the portfolios real quick. I'm going to skip ahead about 6 slides. I'm not going to talk about the valuation. You can download the slides if you want them. You can always reach out, fundinfo@doubleline.com, and we'll have someone follow up with you with these slides and materials as well. But if you look at the low duration bond fund, this is meant to be a low volatility strategy. It has been behaved that way since the inception of it. As Ron pointed out at the beginning, we've done about 110, 120 basis points per annum above our benchmark over the 10 years of running the fund, 10 plus years at this point. And you can see here, we still have significant exposure to the securitized space. So unfortunately, The front of the yield curve continues to be under pressure. So having a 1-year duration or 2-year duration, it really doesn't matter at this point. Things are kind of moving in lockstep with one another there, but we still like the underlying credit components of this. So it's undeniable the strength we see in the housing market. The non-agency RMBS benefit well from that. These are the highest quality CLOs in here. These are primarily all AAA assets. The bank loans we own are more in that crossover space, the double B to the triple B kind of crossover rating areas. So we have roughly a quarter of the portfolio in floating rate assets that are linked to that loan market. So we're obviously very constructed there, but hiding in the highest credit quality of those assets as well. The non-agency CMBS looks nothing like that market. These tend to be shorter assets. A lot of them are rated at the very top of the capital structure. They're AAA or AA rated, so very strong there. We have some governments in here as well. These are actual treasury securities. Just again, offsetting a little bit that we've added to this position as we took down a little bit of our emerging market risk. And we also, decided that it was time to really do that and increase the quality of the portfolio. So the credit quality is starting to move up. As my boss said during our last asset allocation meeting, we went from a world where there was all kinds of stability. There was stability in rates, there's stability in knowing the policies that were forthcoming. There was a world awash in liquidity. And we as a entity, the Fed, whether that's the ECB, the BOE, they are deciding that we are going to take it in a 180-degree different direction. So that means buckle up for a little bit of volatility. We think it's prudent to take down a little bit of the risk positions, but a lot of it was building up into higher credit quality positions for this portfolio. So that's a low duration fund, runs a duration about 1.2 years, has a weighted average life inside of 3. The core fixed income fund, which is our largest of the asset allocation funds. This is the thing that tries to outperform the Barclays US aggregate using sectors of the global fixed income market. And you can see here, our largest position is in governments. These are in treasuries. Next largest is investment grade corporates. By the way, we added to investment grade corporates over the last couple of weeks, some of that spread widening and wanting to buy a little bit more duration into our portfolios. We were running a duration around, let's call it 4 3/4 years, 4.7. And we're in the process during the month end, we were moving this to about 5 1/4 years, which is where we sit today. Some of that's through buying these longer duration corporates, and some of it's through the treasuries, as well as the agency RMBS space. So notice what I'm talking about there. We're selling down emerging markets. We've sold down some of our international or global assets, and we're moving them into higher credit quality assets. We also have taken down our non-agency CMBS a little bit, and we put those into government, U.S. Treasuries, investment grade corporates, and agency MBS. Again, same thematic concept. We think there's a little bit more volatility. Yes, we think rates continue to push upward. We think that there's been a big rate move over the last 7 weeks, and it's time to start nibbling at a little bit of that duration trade while increasing credit quality as well. So you see our positioning still very light in duration relative to the index. Index is about 6.6 years. As I mentioned, right now, we're closer to 5 1/4 years on the strategy as well. So still underweight, still reflective of our view that we think duration can be a hindrance and rates continue to push up. However, we do think that it's time to buy a little bit of that back, just as there's the potential for some of these things to decline a little bit. And then lastly, the Flex Fund. This is our more credit-centric fund. So again, not as much of those safety kind of trades out there. But one thing we did here as well was pare down our international exposure. You see it does not even show up because it's down to 0. Here we took down some of our emerging market risk. And in this portfolio, we did buy a little bit of the governments and the agency RMBS sector. So notice we don't invest in much of the investment grade corporate market. Those IG corporates are actually high yield securities that have been upgraded. That's how you get the 26 basis points there. But in general, we think it's time to, you still want to own some of this credit risk. We want to keep our duration kind of inside of 2 years. And really, as we were buying governments, the question was really, what do you buy? Like if we buy the 2-year, it's like we're jumping out of the frying pan into the fire because we think that's going to have a lot of volatility going forward. So we decided that, let's keep them shorter. Let's just roll some bill positions. And let's see if, we can play a little defense here in the flex strategy. So again, the government position is a little higher than what you see on the screen today. We've been building that. Some of that cash has been put to work since month end. So with that, let me take a few questions. I know I'm running over in time. We're about 65 minutes in. Let me have our compliance slides go through, and I'll tackle a couple of the questions that we have in the queue. If we don't get to your questions, we will get back to you. You can always email us, fundinfo@doubleline.com, and we'll have someone answer your question. So someone's bringing up Uber Bear, David Rosenberg, and talking about the Powell put. And so, the question essentially says, well, don't look at the stock market to be an indicator when the Fed steps in, look at credit. What sign should you look for? So to who's asking that question, the sign you look for are credit spreads. So you follow those spreads that I showed you on there, the IG market, the high yield market, the loan market, look at spreads. If they widen meaningfully, let's say another 100 basis points or so, that may go on the radar of the Fed. They may up their antenna a little bit, but I don't think you should think that there's a pullback of 50 basis points here or there. When the stock market goes down 5% and the Fed wants to jump in. The Fed has changed their narrative. They're fighting inflation. Inflation is their concern. It's the mandate given to them. They're focusing on that. They're not as worried about asset prices. Why are they not? They're getting blamed for exacerbating wealth inequality and the like. So right now, they're going to focus on inflation. It's what the administration wants as well, for them to focus on that. So that way, potentially, midterms may not be as ugly for the Democrats as most are forecasting. So someone says, Sherman, like it that you call me Sherman. Thanks for that. Does it still sound like the Fed's defending the 2% on the 30-year, or could we trade above it for a while? I think we trade above it. It's blown through there. It blew through there as the Fed changed its narrative. And remember, they're not really buying bonds at this point. They're buying a little bit. They're going to be done with that purchase program in about 5 weeks. And they're going to talk about unwinding or letting the bonds roll off the balance sheet. So I don't think there's any defending of any levels at this point. They never explicitly stated that. I know we've talked about it here at Double Line a few times because it was eerie. Every time it got to 2, it rallied. Last time we blew through, it's one of those things. It always works until it doesn't. And I think you got to throw that thinking away at this point in time. So thanks for the question. Is global interest rate rise? How will heavily indebted countries such as Italy survive? By refinancing the debt, as long as there's debt markets and people that want it. So they're very indebted. I get it. The U.S. is heavily indebted, but it's not some imminent risk at this point. Is China uninvestable given the CCP risk? Sure seems that way. It seems very, very risky at this point. So China is not something that we have significant investments in here at Double Line. Who steps in as the marginal buyer? This is a great question. Marginal buyer of MBS and Treasury when the Fed ends QE or begins QT. Where are these buyers rotating assets to do it? So the first buyer that could be natural is the banks, or are the banks. And why do I say that? They're seeing a lot of excess reserves. If they don't want to earn repo and they want to take a little bit of, high quality risk, they could step in there. There's fund managers like ourselves who are underweight these sectors. There's always this idea out there that Double Line's always overweight mortgages. We're not. We're kind of neutralish. They do look a little cheap. I didn't show the relative value stuff there, but we started to nibble a little bit, and we know that the Fed's going to stop buying. So I think that there is some demand there, but ultimately it comes down to the supply, and if supply outstrips demand, that means prices go down. So we think that it's a better place to hide out because if rates are going everywhere, the repricing of risk needs to take place. So even though it may not be on an absolute or an absolute return basis, the best place on a rel val place, it does look a little interesting, which is why we did some of this tweaking at our last asset allocation meeting. If the bond market, next question, if the bond market's already priced in 5 hikes, what happens to bonds now? Well, we can price in 6, we can price in 4, we can price in the terminal rate and that the Fed gets farther along. One thing I didn't talk about in this webcast is the terminal rate, or where the market thinks the Fed stops hiking, and that's at 1.75% today. The Fed themselves and their dot plots say about 2.5 is what they got in the last cycle. So you can always price in more. The one thing is, if the Fed delivers 4 hikes this year and we've got 5 priced in, that's actually supportive of bonds and supportive of some of the risk markets, because at the margin, that is actually a more dovish policy than priced in. So I know it's felt painful. It's been painful to trade these markets, to sit and watch this happen. But a lot of the pain, I think, is behind you on that front of the curve. There is a little bit more in front of us, and that's why we want to be nimble. We want to be able to navigate around, which is why we're talking about some of those quality trade. How long will it take shorter-term bond funds to recover? It be recovered by the time of the duration of the day or the forecast principle. All right. So I think what someone's asking me in that question is, some of these short-term bond funds have negative rates of return. How long will it take to recover? Well, it depends on the path of rates. So it's all about yield, and it's all about where the path of interest rates go. So the good news is the yield now on the front of the curve is enough to offset that loss. So if rates don't continue to push up on the front of the curve, which I do think they still continue to push up a little bit, then that means that the yield can outstrip any of the principal moves, and therefore you can get back to that positive rate of return. Unfortunately, I think that there's a little bit more pain as the market starts to price in a little bit more of the hiking regime here. And so maybe that forecast should be another month or so out there. So, but again, it depends on what those own credit and other parts. Some of them are down a little bit more. Look, I mean, we're buying assets that are at the high quality end of the spectrum that have 2.25, 2.5, 2.75 yields. That gives you the potential to outperform. So I do, if you're looking to monetize a loss there and looking for a home, the DoubleLine Low Duration Fund is a natural place for that as well. So this one, someone's trying to call me out on, you think rates are going up, but are buying longer duration. Won't that get hurt? I just said we're adding duration here. So the whole thing is to keep a balance into the portfolio. And so I've either got to take duration risk, I got to take some credit risk. We've been massively underweight duration. It's led to a very significant outperformance, for example, in our core fund by about 100 basis points relative to the ag year to date. So what we're doing there is saying, okay, we've gotten some of that right. Now it's saying, okay, if there is more noise to come, even as rates reprice, that means we'll be able to buy the credit back cheaper in a couple of months. And so that's kind of the thought there. And just in general, trying to close some of the gap in our duration. We said we were going to buy rates at some point in the cycle, and we started to do so. But even though I think that they're going to continue up, I think there's been a lot of pain in the short term. The velocity of the move has been quick, which means, usually things overshoot. So I'd expect us to see us settle down around 2%. We'll see if we break through there. If we just settle down and the range is really 180 to 2, or if it goes up to that 2.25 or so that we could do. But I'd be a buyer of more duration, probably if rates got to 2.25, especially they did so, let's say over 6 to 8 weeks. And, there's more time to get in that trade. It's all about velocity as well. And that velocity seems to have subsided somewhat in the rate move. And it just seemed like a good time to reduce risk and be able to buy back a little duration. So hopefully that helped you with the question, and you didn't think I was talking out of both sides of my mouth. And with that, the lights are out here. I haven't moved around enough. So that is going to be the end of the webcast today. So thanks, everyone, for all your time. Thank you for spending 1 hour and 15 with me. You can get our slides, fundinfo@doubleline.com. If you want more details on that jobs report, remember Monday Morning Minutes. You can see the Twitter handles on there. You can follow us for all these things. For all these channels, D-Line Channel 11, Ken Shinoda does a great job interviewing industry leaders and giving us some good updates on the DoubleLine thinking. And if you missed it and didn't get a chance to hear at the beginning of the year, the Roundtable Prime Series, one of my favorite events to get all these industry titans in the room together. I let them go at it and just ask them the tough questions. So I thought it was one of the best series we've had to date. And if you want to get more of our data and more of our content, you can follow us on our YouTube channel. It's youtube.com/DoubleLine Capital. And then we also have the one for the DoubleLine funds as well. So thanks, everyone. Take care out there. Keep your level of safety up, both in your portfolios as well as your health. And we'll all get through this pandemic as well as this interest rate environment together. Thanks again.